How to invest in 2021, how anyone can be rich. So you need to start as early as possible. Investing when you're young is one of the best ways to see solid returns on your money. That's thanks to compound interest, which means your investment returns start earning their own return. Compound interest allows your account balance to snowball over time. How that works in practice. Let's say you invest $200 every month for 10 years and earn a 6% average annual return. At the end of the 10-year period, you'll have $33,300. Of that amount, $24,200 is money you've contributed in those $200 monthly contributions, and the $9,100 is interest you've earned on your investment. There will be ups and downs in the stock market, of course, but investing young means you have decades to ride them out and decades for your money to grow. Start now, even if you have to start small. Now you need to decide how much to invest. How much you should invest depends on your investment goal and when you need to reach it. One common investment goal is retirement. If you have a retirement account at work, like a 401k, and it offers matching dollars, your first investing milestone is easy. Contribute at least enough to that account to earn the full match. That's free money, and you don't want to miss out on it. As a general rule of thumb, you want to aim to invest a total of 10% to 15% of your income each year for retirement. Your employer match counts toward that goal. That might sound unrealistic now, but you can work your way up to it over time. For other investing goals, consider your time horizon and the amount you need, then work backwards to break that amount down into monthly or weekly investments. Open an investment account. If you don't have a 401k, you can invest for retirement in an individual retirement account like a traditional or Roth IRA. If you're investing for another goal, you likely want to avoid retirement accounts, which are designed to be used for retirement and thus having restrictions about when and how you can take your money back out. And choose a taxable brokerage account. You can remove money from a taxable brokerage account at any time. A common misconception is that you need a lot of money to open an investment account or get started investing, and that's simply not true. Many online brokers, which offer both IRAs and regular brokerage investment accounts, require no minimum investment to open an account, and there are plenty of investments available for relatively small amounts, and we'll detail them next. Understand your investment options. Whether you invest through a 401k or similar employer-sponsored retirement plan in a traditional or Roth IRA, or in a standard investment account, you choose what to invest in. It's important to understand each instrument and how much risk it carries. The most popular investments for those just starting out include stocks. A stock is a share of ownership in a single company, and stocks are also known as equities. Stocks are purchased for a share price which can range from the single digits to a couple $1,000s, depending on the company. Bonds. A bond is essentially a loan to a company or government entity which agrees to pay you back in a certain number of years. In the meantime, you get interest. Bonds generally are less risky than stocks because you know exactly when you'll be paid back and how much you'll earn. But bonds earn lower long-term returns, so they should make up only a small part of a long-term investment portfolio. Mutual funds. A mutual fund is a mix of investments packaged together. Mutual funds allow investors to skip the work of picking individual stocks and bonds and instead purchase a diverse collection in one transaction. The inherent diversification of mutual funds makes them generally less risky than individual stocks. Some mutual funds are managed by a professional, but index funds, a type of mutual fund, follow the performance of a specific stock market index like the S&P 500. By eliminating the professional management, index funds are able to charge lower fees than actively managed mutual funds. Most 401ks offer a curated selection of mutual or index funds with no minimum investment. But outside of those plans, these funds may require a minimum of $1,000 or more. Now, exchange-traded funds, or ETFs. Like a mutual fund, an ETF holds many individual investments bundled together. The difference is that ETFs trade throughout the day, like a stock, and are purchased for a share price. An ETF share price is often lower than the minimum investment requirement of a mutual fund, which makes ETFs a good option for new investors or small budgets. Pick an investment strategy. So your investment strategy depends on your saving goals, how much money you need to reach them, and your time horizon. If your savings goal is more than 20 years away, like retirement, almost all of your money can be in stocks and also real estate. But picking specific stocks can be complicated and time-consuming. So for most people, the best way to invest in stocks is through low-cost stock mutual funds, index funds, or ETFs. Now, if you're saving for a short-term goal and you need the money within 5 years, the risk associated with stocks means you're better off keeping your money safe in an online savings account that's high interest, a cash management account, or low-risk investment portfolio. Feel free to check out 40inbox.com to master your money, personal finance lessons and courses. Want to make money online? Learn the 4 steps to make money online in the description of this episode.